Okay, I want you to just, for a second, stop what you're doing.
Yeah, this is a big one.
Try to picture a stack of money. And I don't mean a briefcase full of cash. I don't mean a pallet.
Huh.
I want you to visualize $180 billion.
It's a number that is almost impossible to wrap your head around, certainly in a corporate context.
If you stack that in single $1 bills, you are building a paper ladder past the satellites. You're basically on your way to the moon.
It's an astronomical figure. It really is.
It's the GDP of a mid-sized European nation. It's more than the entire market cap of Ford, GM, and Stellantis combined. All of them.
Put together.
And yet, this is the check that Alphabet, Google's parent company, has just announced they intend to write in a single year.
For 2026.
Yeah. And that number, that one single line item on a balance sheet, has completely, utterly sucked the oxygen out of the room on Wall Street today.
It's changed the entire conversation. Everything else feels secondary right now.
It really has. And that's why we're clearing the decks for this deep dive. Because we have a very, very strange dynamic playing out in the markets.
It's a real tale of two economies happening in real time.
It is. On the one hand, you have Google just blasting this colossal, almost unimaginable amount of cash into what they're calling the future.
AI infrastructure.
Right. But on the other hand, if you look at the rest of the market today, the present seems to be having a complete and total nervous breakdown.
So you have this theoretical, incredibly expensive future being built at light speed. And at the same time, you have tangible, physical, real assets that are just crashing.
Exactly. I mean, while Google is out there buying the world, your other assets are screaming for help. Silver just went through a historic flash crash. I mean, a vertical, terrifying drop.
A move that we just don't see in commodities, not at that scale.
Not at all. And then crypto is taking a very cold shower, thanks to a blunt, very clear message from the U.S. Treasury.
No ambiguity there.
None. And if you happen to hold stocks in companies that actually make, physical things you can hold, like Estee Lauder, the tariff hammer just came down, and it came down hard.
So the big question we have to try and answer today is the market broken? Is it just correcting?
Or is the price of admission for the next decade of technology simply way higher than anyone, even the smartest people on Wall Street, had anticipated?
I think that's the core of it. The future just got a lot more expensive.
That is the vibe. So welcome to Theta Fuse. We are going to try to separate the noise of all this panic selling from what might be the signal of massive, massive infrastructure growth. We've got a packed menu today.
We certainly do.
The main course, it has to be Alphabet. They beat earnings, which should be good news, but that spending forecast is frankly terrifying investors.
And for a side dish, we've got that 17%, 1.7 crash in silver. Metals aren't supposed to move like tech stocks, but, well, here we are.
And for dessert, or maybe it's indigestion, we have a serious reality check on trade wars, courtesy of Estee Lauder.
And we'll wrap it all up with a quick look at Amazon because they are really the next domino that has to fall in this whole infrastructure narrative.
Absolutely. But we have to start with the sticker shock. We have to unpack this Google situation. Because I looked at the earnings report this morning, and on the surface, I mean, it looked like a victory lap.
Oh, absolutely. If this were any other year or, maybe any other sector, the stock would probably be up 10, maybe 15% on this news.
For sure.
Alphabet reported Q4 earnings that were, by any objective measure, stellar. Revenue came in at $113.8 billion.
Which is up 18% year over year.
18%. For a company of that size, growing at that rate is like watching an elephant sprint. It's just immense momentum.
It's staggering.
It is. And they beat on the bottom line, too. Earnings per share were $2.82. The street was only looking for about $2.65.
So they're more profitable than expected. They're growing faster than expected. And the core business, search and YouTube, is just printing money.
It's a cash machine.
So in a rational world, everyone high-fives, the stock goes up, and we move on.
Yeah.
But we are not in a rational world, are we? We're in an AI world.
We are. And the market looked at that profit, gave it a polite nod, and then their eyes went straight to the forecast for capital expenditures.
CapEx.
And for 2026. And that's when the room went dead silent.
This is really where the rubber meets the road. I mean, the analysts, the people who are paid millions of dollars to model these companies out to the penny, They were already expecting a big spend.
Oh, yeah, a huge spend was priced in. They know AI is expensive. They had penciled in a forecast of, what, about $119.5 billion for 2026 CapEx?
Which, let's just pause there. $120 billion is already an absurd, mind-bending amount of money.
It's already a record-breaking number for any company ever.
Right. But Google came out and said, no, you're thinking too small. We're looking at $180 billion at the midpoint.
They didn't just miss the estimate. They shattered it. They overshot by $60 billion.
That miss alone is the entire market cap of a company like General Motors. They're spending an extra GM just on top of what everyone was already bracing for.
It effectively means they are going all in. There's no hedging here. There's no dipping a toe in the water. This is a total, full-throated commitment to building out infrastructure.
I want to stop here for a second and do a little jargon busting, because we throw around CapEx a lot on this show, but it's really important to understand what it means.
Yeah.
For the listener who might be, prepping for a meeting or just trying to manage their own portfolio, let's break down what that actually means, because $180 billion isn't going to salaries or marketing, right?
No, and that's the crucial distinction. You have your operating expenses, or OpEx. That's the day-to-day stuff.
The lights, the coffee.
Exactly. Salaries, marketing budgets, the electric bill for the offices, the snacks in the break room. That's the cost of keeping the business running.
Right.
CapEx is completely different. CapEx is buying the house, not renting it. It's building the factory. It's an investment in a long-term physical asset that you own, and that depreciates over time.
So, in Google's specific case, what does $180 billion actually buy? Are they, I don't know, paving a country in silicon?
It's not far off. In this context, CapEx is almost entirely synonymous with the physical layer of artificial intelligence. And we really need to be specific about what that entails, because it is so much more than just buying chips from NVIDIA.
Right, that's the common perception. Everyone just assumes it's sending a couple of very large wire transfers to Jensen Huang at NVIDIA.
And look, that's a big part of it for sure. They are buying tens of thousands of H100s, Blackwell chips, whatever the latest and greatest is. But here's the key part. Google is also spending heavily on custom silicon.
Their own chips.
Their own chips. They are fabricating their own TPUs, tensor processing units. The research and development, the foundry capacity for their new Trillium chips, that is all incredibly capital intensive.
So this is an effort to own the supply chain, or at least a part of it, not just rent it from somebody else.
Correct. They want to control their own destiny. But then, okay, you have all these chips, you have to put them somewhere.
In a data center.
In a data center. And we are not talking about the server farms of 2010. We are talking about gigawatt scale facilities. These are no longer just warehouses with servers. These are massive, complex industrial projects that require millions of tons of concrete, of steel, of copper. The construction costs alone are staggering.
And once you build the building, you have to plug it in. And I get the feeling that's not as simple as it sounds.
That is the hidden cost that is blowing up all of these budgets. Energy resilience. You cannot just plug a gigawatt-scale AI cluster into the municipal grid and expect it to work. You would dim the lights in the entire neighboring city.
So what do?
Google is having to invest directly in energy generation. They're building solar farms, wind farms, and signing massive power purchase agreements. They're investing in grid modernizations, substations, and, critically, enormous liquid cooling systems, because these chips run incredibly hot.
So they're building their own private utility network.
That's exactly what it is. They're becoming a vertically integrated compute utility.
It really does sound like the Industrial Revolution all over again. It reminds me of the stories of when Henry Ford had to go out and buy rubber plantations in Brazil and his own steel mills because the supply chain he needed didn't exist yet.
That is the perfect analogy. Ford had to build the entire ecosystem to support the Model T.
And Google's doing that for AI. They're vertically integrating the physics of computation.
They are. And just like it was for Ford in the early days, it is a massive, massive risk. If you build a factory that big, you have to run it at or near capacity just to make the math work. There's no room for error.
Which brings us to the market reaction, which was, I'd call it hesitant. The stock dipped about 1% in the pre-market after being down as much as 2% overnight. It wasn't a panic dump by any means.
Wow.
But it was definitely a whinge. It feels like investors are collectively asking, is this actually going to pay off, or are you guys just lighting a giant pile of money on fire?
That is the $180 billion question, isn't it? And to even begin to answer it, you have to look very closely at what the CFO, Anat Ashkenazi, said on the earnings call. She clearly anticipated this fear.
She knew this number would shock people.
Of course. And she didn't sound like someone who was just gambling. Her message was very clear. She said, and I'm quoting here, "These investments are already delivering results."
But do we trust that? I mean, is that just the standard corporate speak you have to say to stop the stock from tanking? Don't worry, trust us, it's all working out.
Well, normally I might be skeptical, but in this case, we actually have hard numbers to back it up. And this is probably the single reason why the stock held up as well as it did. You have to look at Google Cloud.
Okay, the cloud division, the competitor to AWS and Azure.
Right. Revenue for Google Cloud absolutely spiked. It was up 48% to $17.7 billion.
48% growth.
48%. That beat expectations, which were around $16.2 billion by a mile.
For a business unit of that size, that is startup speed. That's hypergrowth.
It is nearly unprecedented for a mature multi-billion-dollar business unit to accelerate its growth rate like that. And this is the crucial part. CEO Sundar Pichai explicitly linked that growth to AI.
So he's connecting the dots for investors.
He's drawing a straight line. He said AI is driving demand for cloud services, and it's even helping to drive core search revenue. Their argument is essentially, we aren't spending $180 billion on a fantasy or a science project. We're spending it because customers are banging down our door asking for capacity that we literally do not have yet.
So the argument is, if we don't build the tracks, we can't run the train. And if we don't run the train, we know for a fact that Microsoft or Amazon will.
Precisely. It's both a defensive moat to protect their core business and a massive offensive weapon to capture the next wave of computing. They're operating from what they call a position of strength.
Meaning they have the cash flow?
They have the cash flow from search to fund this war. And make no mistake, it is a war. And in this war, the ammunition is capital.
But I have to play devil's advocate here for a minute. I'm looking at this from the perspective of a regular investor, maybe someone who has GOGL in their 401k. 180 billion is a number that creates its own kind of gravity. If this AI demand slows down, not disappears, just slows down even a little bit, aren't they just left with a bunch of rapidly depreciating servers in a desert somewhere in Arizona?
That is the bear case in a nutshell. That is the field of dreams risk. If you build it and they don't come, or they don't come in the numbers you projected, you have a massive, massive hole in your balance sheet.
It changes the company's DNA.
It fundamentally does. We are witnessing a historic shift from Google being a capital-light, high-margin software business to becoming a capital-heavy, lower-margin industrial utility. That completely changes the margin profile of the company, and it absolutely changes the risk profile.
So it's a high-stakes poker game. And Google didn't just raise. They shoved all their chips, and apparently a few $1 billion of borrowed chips, right into the middle of the table.
They did. And speaking of chips and volatility, we need to pivot. Because while Google is placing this enormous bet on the future, something very strange and very violent happened to a very, very old asset class this morning.
Yeah, let's talk about the commodities crash. Because my phone absolutely blew up this morning with alerts about silver. And for a good 30 seconds, I was convinced the data feed had to be broken.
It looked like a glitch in the matrix. It really did.
We are not talking about a gentle slide here. Spot silver plummeted. It fell as much as 17% during the Asian trading hours. It just dropped like a stone towards $73 an ounce.
And I want to put that in perspective for everyone. For a major global commodity like silver, a 17% move in a few hours is practically unheard of. That is, penny stock volatility. That is meme coin behavior.
It's not supposed to happen.
It is absolutely not how precious metals are supposed to behave.
And it wasn't a slow bleed over the course of the day. It wiped out a pretty solid 2-day recovery in literally a matter of minutes.
It was a waterfall event. And gold took a hit too. It was down about 3.5%. Copper was off about 1.5%. But silver was the epicenter of this. It was the main victim.
So what on earth happened? How does an entire global market break like that?
This was a classic, almost textbook example of a liquidity squeeze colliding with a violent momentum reversal. To understand it, you have to understand the mechanics of the silver market right now.
Okay.
For the last year or so, there has been massive, and I mean massive, speculative momentum coming out of China.
So it's Chinese investors bidding up the price.
Heavily. Retail investors, hedge funds, everyone was piling into the long silver trade on the Shanghai Futures Exchange. It became an incredibly crowded trade. And as any trader knows, when a trade gets that crowded, The exit door gets very, very small.
Okay, so you have a crowded room. What triggered the fire alarm?
Well, the reports suggest it was a sudden unwinding of bullish positions. Basically, sentiment shifted on a dime. Maybe it was a big fund taking profits. Maybe someone got a margin call. We don't know the exact trigger. But the selling started. And crucially, it started during Asian trading hours.
Why does the timing matter so much?
It matters because of liquidity. During Asian hours, the major London and New York banks, the big market makers who usually step in and provide bids and asks to smooth out volatility, they aren't fully active yet. Their main trading desks aren't staffed. The order book, as we call it, is thin.
I see. So when someone tried to sell a large block of silver, there just wasn't anyone on the other side of the trade to buy it at the current price.
Exactly. I like the analogy of a crowded nightclub.
Haven't been to one in years, but go on. I'm following.
Imagine a packed club. It's midnight, everyone is dancing, having a great time. That's the bull market in silver. Suddenly, someone pulls the fire alarm. That's the sudden shift in sentiment.
Okay.
Now, everyone, all at once, tries to sprint for the single, small exit door at the exact same moment.
It's a stampede.
It's a stampede. And because it's the middle of the night Asian trading hours, the bouncers who would normally manage the crowd and keep things orderly aren't there.
So in financial terms, the bids just vanished.
They evaporated. The price has to drop further and further and further down just to find a willing buyer. And this triggers the next phase. The computers take over. This initial drop triggers stop-loss orders on other accounts.
Which is an automatic sell order.
An automatic sell order, which adds more selling pressure, which pushes the price down even more, which triggers even more stop-losses. It's a vicious feedback loop, a cascade.
So the computers see the drop, sell automatically, and just make the drop exponentially worse.
Precisely. Now, by later in the day, as London and New York came online, silver had pared its losses. It was down about 10 or 11% when things settled, but the damage was done. This was a classic washout.
So for the listener who might be holding silver, or maybe they own an ETF like SLV, is this the end? Is the shiny metal done for?
Not necessarily. In fact, seasoned traders often look at this kind of violent move as a clearing event.
What do you mean by that?
It washes out the latecomers. It liquidates the people who bought at the top, usually with borrowed money, with high leverage. It doesn't necessarily mean the fundamental long-term reasons to own silver, like its industrial demand from solar panels or electronics, or its role as an inflation hedge, have suddenly changed overnight.
But it is a very painful reminder that gravity works.
Gravity works and leverage kills. If you were trading silver on margin this morning, you probably got wiped out. No question.
Speaking of gravity and getting wiped out, let's talk about another asset class that is feeling the pull of the earth today. Crypto.
Yeah, the so-called digital gold didn't fare much better than the real stuff.
No, it didn't. Bitcoin sank below $70,000. And this wasn't just random market noise or another liquidity air pocket. This move had a very specific, very official catalyst, didn't it?
It did. The push came directly from the U.S. government. Treasury Secretary Scott Bessent made a definitive statement that sent a real shiver through the entire crypto market.
And what did he say?
He essentially said, in no uncertain terms, that the U.S. government cannot and will not tell banks to bail out crypto.
Ouch. That is about as direct as it gets from a government official.
It was a very clear sink or swim message from the feds. And you have to understand the context here. For a long time, there's been this prevailing institutional adoption narrative in crypto.
Right. The idea that the big money is coming.
Exactly. The idea that as Bitcoin and other cryptos get bigger, they'll become more integrated into the traditional banking system. And with that integration comes an implicit assumption that the government would create safety nets, or at least gentle regulations to keep it all stable.
You know, like they do for the stock market after a crash, or the
Yeah.
bond market. The Fed put.
Precisely. But Bessent just poured a giant bucket of ice water all over that idea. He is drawing a very clear line in the sand. He's effectively saying, listen, if you want to be a decentralized asset that lives outside the traditional system, fine, go be decentralized. We're not stopping you. But don't come crying to the centralized banking system for a bailout when things break.
It's basically, you wanted to be your own bank. Congratulations, you are now your own bank. Good luck with that.
And the market, which craves certainty above all else, hated that message. We saw the ripple effect immediately. The most obvious place was Strategy Inc. The ticker is MSTR.
Right, MicroStrategy, which for all intents and purposes is just a leveraged Bitcoin holding company disguised as a software firm.
It's the cleanest public proxy for Bitcoin exposure, and their stock fell 5% in the pre-market on this news. Investors were clearly hoping for a friendlier regulatory stance, maybe a boost from the administration, talk of a strategic Bitcoin reserve, something supportive.
Instead, they got the cold shoulder.
A very cold shoulder. It just changes the entire risk calculation. If there is no implicit government backstop, no lender of last resort, then the asset is definitionally riskier.
It really seems like the theme of the day. The easy money speculative trade is getting hit from all sides.
It is. But let's shift gears and move from the speculative to the real stuff trade, because this next story about Estee Lauder, this is one that actually made me wince a little when I read it.
This is where abstract macroeconomics comes home and hits your bathroom vanity.
It really, really does. So Estee Lauder reported earnings, and if you just look at the top line numbers, they had a great quarter.
A fantastic quarter. They beat earnings expectations soundly. EPS was $1.19 versus the 83 cents analysts expected. Revenue was up a healthy 6% to $4.23 billion. People are buying the night cream, they're buying the lipstick. The core business is healthy.
Fundamentally, yes. The consumer is there. And yet the stock tumbled 10%. It was down as much as 13% in the pre-market at one point. And the reason can be summed up in one word: tariffs.
We usually talk about tariffs in this very abstract academic sense. Oh, trade wars might cause some inflation eventually. But Estee Lauder just put a very specific, very painful price tag on it today.
They did. In their guidance, they warned of a $100 million hit to profitability in fiscal 2026, a direct hit. And it was specifically due to new tariffs. And they even named names. They broke it down by country.
Yeah, the specifics were just brutal. They called out a 39% tariff on Swiss imports and a 35% tariff on Canadian imports.
39%. I mean, think about their supply chain for a second. Estee Lauder is a prestige luxury brand. They manufacture a lot of their high-end fragrances and complex skincare products in Switzerland.
Why? Because that's where the expertise is, the labs, the scientists.
Exactly. You can't just move that kind of specialized production to a warehouse in Ohio overnight and expect the same quality. It's not possible.
No way. The supply chains for these luxury goods are incredibly rigid and specialized.
They are. So if the U.S. government suddenly slacks a 39% tax on everything coming into the country from Switzerland, Estee Lauder is left with two terrible choices. One, they can raise their prices by 40%, which would almost certainly kill demand for a luxury good, or they can eat the costs themselves.
And that $100 million profit warning tells you they're eating the cost.
Exactly. It comes directly out of their bottom line, directly out of shareholder profits. And it's such an important lesson for investors. You can do all your homework. You can analyze a company's product, their marketing, their management team, and they can be doing everything right.
Firing on all cylinders.
Exactly. But if the policy environment changes, if the rules of the game get rewritten at the border, you can still lose 10, 13% of your value in a single morning.
It's a harsh reality check. A great earnings report doesn't matter one bit if the government decides to take all the profit at the port of entry.
Precisely. So let's just zoom out for a second. We have Google spending a fortune to build the future. We have silver crashing because of speculative leverage. We have crypto getting the cold shoulder from regulators. We have Estee Lauder getting hammered by taxes. It feels like a minefield out there today. What are we watching next? What's the next shoe to drop?
All eyes, and I mean all eyes on Wall Street, now turn to Amazon.
They report earnings post-market today, on Thursday. And this report has suddenly become critical.
Explain that. Why is Amazon the linchpin here all of a sudden?
Because of the AI narrative. We just spent 20 minutes talking about Google's massive spending, which they justified with their incredible 48% growth in Google Cloud.
Right. They set a very, very high bar.
An incredibly high bar. That number suggested that the demand for AI infrastructure is not just real, it's accelerating at a pace no one expected.
So we need Amazon to confirm that story. It can't be a one-off.
Right. If it's a real durable trend, it has to show up in the other major players. The key metric everyone will be watching is AWS Amazon Web Services. The whisper number, the analyst expectation, is for a sales jump of roughly 21%.
And here's why this matters so much to me. If Amazon comes out and misses on cloud, if they say AWS growth is slowing down to, say, 15 or 16%, then suddenly Google's $180 billion spending spree looks a lot less like a genius strategic move and a lot more like a reckless gamble.
It would suggest Google is building capacity that the market doesn't actually want or need yet. It would poke a huge hole in the entire narrative.
But what if Amazon beats? What if AWS growth reaccelerates to 25 or, heaven forbid, 30%?
Then the boom is confirmed. It's real. It means the demand is widespread. It's not just a Google phenomenon. And that $180 billion bet is probably a very, very smart move. The entire tech sector probably rallies on that news.
It connects everything. If Amazon beats, it validates the expensive future thesis we started with. If they miss, we might see another leg down in the tech sector because the whole growth story will have a serious hole in it.
So we're all on the edge of our seats for that report.
We are. But we promised our listeners a strategy. We have all this chaos, massive spending, flash crashes, tariffs. How does a regular investor navigate this kind of market?
It is time for our daily investment insight, the part of the show we call the Theta Fuse strategy.
So what's the play today?
We are calling this one the infrastructure coattail ride.
I like the sound of that. Break it down for me. What does it mean?
Okay, look at the landscape we've just painted. We have massive, unpredictable volatility in commodities like silver. Trying to catch that falling knife right now is dangerous. You have no idea when or if the liquidity will return.
Okay, so avoid that.
Then we have these sudden, sharp policy risks in consumer goods like Estee Lauder. That's totally unpredictable. You don't know what the next tariff announcement will be or which country it will target.
So we avoid the chaotic edges of the market. We stay away from the things that can be broken overnight by a government decision or a sudden liquidity squeeze.
Exactly. But look at the center. Look at the one thing we know for a fact is happening. Google is spending $180 billion.
That money isn't just vanishing into thin air. It is being paid to someone.
Precisely. That money is flowing to the chip makers. It's flowing to the energy providers. It's flowing to the construction and engineering firms that build data centers. And most importantly, the result of that spending is generating massive revenue for the cloud providers themselves.
So the core of the strategy is, don't try to pick the winner of the AI software wars. Don't place a bet on which chatbot or application will be the best one in 2030 because we have absolutely no idea.
No, that's a guessing game right now. Instead, bet on the builders. Bet on the people selling the picks and shovels in this gold rush. Look at the cloud and infrastructure providers themselves.
Well, how do you play that?
You watch the price action in the major cloud players. For example, if Amazon reports solid AWS growth, but the stock dips for some other reason post-earnings, that could be an opportunity. If Google's stock stays depressed because investors have sticker shock over the CapEx number, but you see they are growing their cloud division at nearly 50%, that could be an opportunity.
So the rationale is that the CapEx fear is a short-term emotion. It's a sticker shock. Investors just hate seeing companies spend money. But the revenue growth in the cloud divisions, that's the long-term fundamental signal.
Exactly. The builders of the AI age, the companies laying the physical foundation, are showing the most tangible, impressive revenue growth right now. If you can stomach the inherent volatility of the tech sector, that is where the coattails are. You ride the massive spending wave. You align your portfolio with the companies that are either receiving those $180 billion checks or are the ones deploying that capital to generate massive recurring revenue.
I love it. It's a simple, logical way to cut through all the noise we've seen today. But as always, we have to keep the lawyers happy and, more importantly, keep our listeners safe.
We absolutely do. The content of this podcast is for informational purposes only. Everyone's financial situation is different, and the thoughts we provide here may not be applicable to you. We are not financial advisors. Please consult with a professional before making any investment decisions.
Good advice. Okay, let's wrap this up. What a day, what a market.
It's been a whirlwind, a lot of cross currents.
To recap, we've got Google spending $180 billion to literally build the future. We've got silver and crypto giving us a very stark reminder that gravity still exists.
And it is undefeated.
And we've got tariffs taking a very real, very measurable bite out of the real economy with companies like Estee Lauder.
It's a market in transition. And transitions are always, always messy.
I want to leave our listeners with one final thought, a provocative one to chew on while you're stuck in traffic or walking the dog.
Go for it.
Google is spending $180 billion on infrastructure in 2026. That is more than the GDP of many nations. If they are right about the demand for AI, if this is truly the new industrial revolution, on par with the railroad or the electrical grid,
then they will own the future operating system of the entire planet.
And buying these assets now, on a dip caused by spending fears, is the bargain of the century. That's the bull case.
It's a powerful one.
But what if they are wrong? Or not even completely wrong, just a little bit wrong. What if the demand plateaus? What if the AI models stop getting exponentially smarter? What happens to a $180 billion hole in the ground? What happens to the entire tech sector if the field of dreams turns into a ghost town of empty data centers?
That is the trillion-dollar risk, and that is why we watch the numbers every single day.
Keep your stop losses tight and your eyes on the cloud. This is Theta Fuse.
See you next time.